While most investors are getting crushed by pathetic 2% yields and watching their retirement dreams evaporate, there's a $1.5 billion fund that's been quietly paying 15% monthly income using Warren Buffett's exact stock picks. This isn't some risky scheme. It's the same strategy that institutional investors have been using for decades to extract passive income from market volatility itself. So if you don't know what I'm talking about, QQQI was crowned the 2025 Best New Active ETF and has skyrocketed to $1.5 billion in AUM since January 2024 inception with a 16.5% annualized return. But QQQI is just one piece of a much bigger story that's unfolding right now. A story about 3 dividend ETFs that are rewriting the rules of retirement/passive income, and why the biggest players in finance have been keeping this strategy locked away from regular investors. Until now. Hello, I'm Andrew. Let me start today's video with a number that's going to change how you think about passive income forever. $400,000. That's all you need invested to generate $60,000 per year in passive income with these new ETF investing strategies. Compare that to traditional advice that says you need $1.5 million to safely withdraw the same amount. You think I'm exaggerating? Let's do the math. Traditional retirement planning assumes a 4% safe withdrawal rate. To get $60,000 annually, you'd need $1.5 million invested. But with a sustainable 15% dividend yield from these revolutionary dividend ETFs, you only need $400,000. That's not a small difference. That's the difference between working until you're 70 versus retiring at 55. That's the difference between worrying about every expense versus actually enjoying your golden years through smart dividend investing. But here's where things get interesting, and where this story really begins. These yields aren't coming from some speculative crypto scheme or penny stock pump and dump. They're coming from a sophisticated option strategy that's been used by hedge funds and institutional investors for decades. The only difference? Now regular investors can access it through modern ETF investing. So why haven't you heard about this before? Well, that's where our story takes a darker turn. See, what these 3 ETFs are actually doing is something called covered call strategies. They own stocks and systematically sell options against those holdings to generate extra income. It's a sophisticated approach that's been the secret weapon of hedge funds and institutional investors for decades. But here's the problem. These covered call strategies used to require millions of dollars in capital and sophisticated trading systems to execute properly. Only hedge funds and family offices had access because you needed teams of options traders and risk managers to make it work. Wall Street has been perfectly happy keeping it that way. Why would they tell you about 12 to 15% yield strategies when they can sell you expensive mutual funds with 2% yields and collect management fees year after year? The longer you stay in their traditional products, the more money they make. But here's what changed. Advances in technology and ETF structures finally made it possible to package these institutional strategies into funds that regular investors can buy. The same algorithms that hedge funds use to manage options portfolios can now be scaled down and automated. I discovered this when a colleague showed me his retirement account last month. He's a government employee, not exactly a Wall Street insider, but his financial advisor had quietly moved a portion of his 401k into these income investing vehicles. While other friends were complaining about their pathetic bond yields, he was generating more passive income from $200,000 than most people make from $1 million in traditional investments. That's when I went down the rabbit hole and discovered what's really happening in the income investing market. And what I found wasn't just interesting, it was borderline shocking. These 3 funds, SPYI, QQQI, and OMAH, have cracked the code on turning market volatility into monthly paychecks. But each one uses a completely different approach, and understanding the differences could mean the difference between financial freedom and just another disappointing investment. So let me walk you through each of these income machines, starting with the most conservative and working our way up to the most aggressive. Because by the end of this, you'll understand exactly how institutional investors have been generating double-digit income for decades, and how you can finally access the same strategies through modern dividend investing. The first fund we need to understand is SPYI, the NEOS S&P 500 High Income ETF. SPYI is delivering a 12.11% annual distribution rate, making it a standout in the dividend ETFs category. It passively holds all 500 stocks in the S&P 500 index, giving you the same diversification as a basic index fund. But here's where it gets interesting. They actively manage an options overlay using SPX index options. And this is where the magic happens. Most people think covered calls are simple. You own a stock, you sell a call option against it, and you collect the premium. But SPYI uses something much more sophisticated. It passively holds S&P 500 stocks as its equity base but actively manages the options overlay, buying and selling S&P 500 index options. They're not just selling calls, they're buying and selling multiple strikes at the same time, creating what's called a call spread strategy. This allows them to capture option premium while limiting how much upside they give away. It's like being the house in Vegas, but with built-in risk management. And here's the tax advantage nobody talks about. SPX index options fall under Section 1256 of the tax code, meaning that gains are taxed on a 60-40th split, 60% long-term, 40% short-term, regardless of holding period. Let me translate that into real dollars. If you're in the 24% tax bracket and you generate $20,000 in passive income from SPYI, you might pay around $3,200 in taxes instead of the $4,800 you'd pay on ordinary dividend income. That's $1,600 back in your pocket every year. But it gets even better. A significant portion of its 12.11% distribution yield is classified as return of capital, which is tax efficient since it reduces your cost basis instead of generating immediate taxable income. Now, let's talk numbers. Since launching in August 2022, SPYI has navigated some challenging market conditions. The fund charges a 0.68% expense ratio, which sounds high until you realize you're getting institutional-level options management for less than what most financial advisors charge. Here's the real test. During the 2023 bull market, SPYI achieved a total return of 18.1%, underperforming the S&P 500's 26.3% return. That's the trade-off. You give up some upside in exchange for consistent monthly income through strategic dividend investing. But here's what most people miss. In volatile or declining markets, SPYI typically holds up much better because it's generating income even when stock prices are falling. It's designed for income investing, not maximum growth. Let me show you what this looks like in practice. If you invested $100,000 in SPYI at the current 12.11% yield, you generate about $1,010 per month in distributions. That's enough to cover most people's car payments, insurance, and gas, all from one ETF investing decision. Scale that up. $500,000 in SPYI would generate roughly $5,055 per month, or over $60,000 annually. That's a meaningful passive income stream that could cover major living expenses in retirement. But if SPYI is the steady workhorse, our second fund is the high-performance engine. Meet QQQI, the NEOS Nasdaq 100 High-Income ETF. QQQI boasts a gigantic 13.92% distribution yield, and there's a very specific reason why this fund can generate higher income than SPYI while representing one of the most innovative dividend ETFs available today. QQQI tracks the Nasdaq 100 index, which means you're getting exposure to the 100 largest non-financial companies on the Nasdaq. We're talking about Apple, Microsoft, Nvidia, Meta, Amazon. Basically the entire tech ecosystem that's been driving market gains for the past decade. Here's something most investors get completely backwards. Volatility isn't your enemy when you're selling options. It's your best friend. QQQI's high payout is largely driven by the Nasdaq 100's elevated volatility, and future monthly distributions can fluctuate depending on market conditions. When tech stocks swing wildly, option premiums become more valuable. It's basic supply and demand. When there's more uncertainty, people pay more for insurance against that uncertainty. QQQI is essentially selling that insurance and collecting the premiums, making it a powerful tool for income investing. QQQI has outperformed QYLD and JEPQ in total returns, price returns, and yield while offering better tax efficiency. Let me put that in perspective. QYLD has been around since 2013 and has billions in assets. JEPQ is managed by JP Morgan, one of the largest asset managers in the world. Yet QQQI, which only launched in January 2024, is beating both of them across multiple metrics, establishing itself among the top dividend ETFs for tech exposure. Since its inception, QQQI has delivered a 14.08% cumulative return, outperforming the CBOE Nasdaq 100 Buy Right Monthly Index, which returned 12.19% over the same period. That means you're getting higher income and better total returns through smart ETF investing. QQQI holds approximately 100 stocks, but like the Nasdaq 100 itself, it's heavily concentrated in the biggest tech names. Apple typically represents around 8 to 9% of the fund, Microsoft around 7 to 8%, and Nvidia has been growing its weighting as the stock has soared. This concentration is both a feature and a risk. When tech is hot, QQQI benefits from both the underlying stock appreciation and higher option premiums from increased volatility. But when tech sells off, you feel it more acutely than you would with SPYI's broader diversification. One question I get constantly is, how consistent are these monthly distributions? With QQQI, the answer is fairly consistent, but with variation. The fund targets that 13.92% annual yield, but monthly payments can fluctuate based on market volatility and option premiums. For example, in a calm month where tech stocks barely move, QQQI might distribute 10 cents per share. But in a volatile month where stocks are swinging 3 to 4% daily, that distribution might jump to 13 cents per share because option premiums are richer. Like SPYI, QQQI benefits from the same Section 1256 tax treatment and return of capital distributions. QQQI actively tax loss harvests, helping boost the portion of distributions classified as ROC. This is huge for high earners focused on income investing. If you're in a state with high income taxes, the difference between ordinary income treatment and the 60-40 capital gain split could save you thousands of dollars annually. Now we get to the most fascinating fund of the three, OMAH, the VistaShares Target 15 Berkshire Select Income ETF. This fund takes a completely different approach that's borderline genius in its simplicity, representing a unique innovation in the dividend investing space. OMAH offers investors a core equity portfolio that generally mirrors the 20 largest holdings of Berkshire Hathaway while leveraging the experience of the portfolio management team to seek to generate high passive income. Think about what this means. You're getting Warren Buffett's stock selection expertise, arguably the greatest track record in investing history, combined with a systematic income generation strategy targeting 15% annual yields through innovative ETF investing. OMAH doesn't just randomly pick value stocks and hope for the best. It monitors regulatory filings, such as 13F filings, and other public disclosures to adjust the fund's allocations as needed. Every quarter, when Berkshire files its 13F showing what stocks Warren Buffett is buying and selling, OMAH adjusts its holdings to match. So if Buffett adds to his Apple position or trims Bank of America, OMAH makes similar moves. The fund typically holds the top 20 Berkshire positions, which currently includes names like Apple, Berkshire's largest holding, Bank of America, Chevron, Coca-Cola, and American Express. These aren't growth stocks. They're mature, profitable companies that generate substantial cash flows. Here's where OMAH gets really interesting. The fund seeks to generate income primarily through the use of option strategies involving options contracts on certain or all of its underlying securities, with the fund aiming to achieve an annual income target of 15%. That 15% target isn't just marketing. It's a specific income goal that the fund actively manages toward. They'll adjust their option strategies based on market conditions, volatility levels, and the characteristics of individual holdings to try to hit that target consistently, making it one of the most ambitious dividend ETFs available. Now, OMAH comes with a higher concentration risk than SPYI or QQQI. By focusing on the top holdings of Berkshire Hathaway, OMAH may have less diversification compared to broader market ETFs, potentially increasing sector or company-specific risks. Where SPYI holds 500 stocks and QQQI holds 100, OMAH typically holds just 20 to 25 positions. That means individual stock movements have a bigger impact on the fund's performance. If Apple has a bad quarter, you'll feel it more in OMAH than you would in SPYI. Now, before you liquidate your entire portfolio and go all in on these dividend ETFs, let me share the one thing that most people get wrong about this strategy, and it's the key to using it successfully. Covered call ETFs consistently underperform basic index ETFs over time due to capped upside and higher management fees. All three of these funds trade maximum upside for consistent income. Here's a concrete example. During March 2024, when Nvidia soared 30% in a single month, QQQ, the underlying Nasdaq 100 ETF, captured most of that gain. But QQQI, because of its covered call strategy, only captured about 18% of that move. The remaining 12% went to the investors who bought the call options from QQQI. But here's the flip side. During the April 2024 tech sell-off, QQQI successfully navigated the April crash and recovery with grace. While QQQ dropped sharply, QQQI's option income helped cushion the fall. These income investing strategies work best in three market environments. 1. Sideways markets. When stocks trade in a range, these funds generate income while regular index funds go nowhere. 2. Volatile markets. Higher volatility means richer option premiums and higher passive income. 3. Declining markets. The income helps offset capital losses better than buy-and-hold strategies. They struggle in explosive bull markets where you'd rather own the stocks directly and capture all the upside. So here's what sophisticated investors are actually doing with these dividend ETFs. And this is the part that most financial advisors don't understand. They're not using these as total portfolio replacements. They're building what I call income ladders within broader diversified portfolios. A better alternative might be a hybrid approach. Keep SCHD for growth and stability, using its dividends to gradually build positions in SPYI and QQQI through strategic ETF investing. The Age-Based Allocation Framework. Ages 25 to 40. Growth phase 5 to 10% allocation maximum. Use these dividend investing strategies to generate monthly passive income that covers specific expenses, car payment, insurance, etc., while keeping most money in growth investments. Ages 40 to 55. Transition phase 15 to 25% allocation. Start building a more meaningful passive income stream while still prioritizing growth. Consider 10% SPYI, 10% QQQI, 5% OMAH. Ages 55 plus. Income phase 30 to 50% allocation. Focus shifts to income investing. Consider 20% SPYI for stability, 15% QQQI for tech exposure, 10% OMAH for the Buffett premium, with the remainder in bonds and cash. Before we end the video, here's a practical approach that a friend of mine uses. Instead of thinking about total return, think about expense coverage. Calculate your major monthly expenses. Housing, $2,000. Transportation, $800. Insurance, $400. Food, $600. Total, $3,800 per month, or $45,600 annually. At a 12% average yield across these dividend ETFs, you'd need roughly $380,000 invested to cover those core expenses through passive income alone. That's a specific, achievable target that's much more concrete than vague retirement planning rules. Let me share some real numbers that put this whole dividend investing strategy in perspective. A Redditor recently invested $200,000 split between SPYI and QQQI for their high yields. Here's what that actually looks like. $100,000 in SPYI at 12.11% yield equals $12,110 annually, $1,009 monthly. $100,000 in QQQI at 13.92% yield equals $13,920 annually, $1,160 monthly. That's over $2,100 per month in passive income from a $200,000 investment. Compare that to a traditional 60-40 portfolio yielding maybe 3%, which would generate just $6,000 annually or $500 monthly. But here's the reality check. Over 9 years, this income could support early retirement, especially if reinvested, but this strategy sacrifices growth potential. So there you have it, the 3 dividend ETFs that are rewriting the rules of retirement income through innovative ETF investing and smart income investing strategies. The choice is yours. Keep learning dividend investing, stay diversified, and remember that the best opportunities for passive income are often hiding in plain sight.